Folks, it's Sean Kidney from the Climate Bonds Initiative here. I'm the CEO. With me in her own room in another part of London, because it's an entirely virtual conference, is my great friend Marisa Drew, who has an extraordinarily long title at Credit Suisse, Chief Sustainability Officer and Global Head of Sustainable Strategy, Advisory and Finance, which means if you want to talk sustainability in Credit Suisse, Marisa's the person to speak to. But she's also got a lot of other roles. Later on in this conference, tomorrow, we'll be hearing her speak in her capacity as a Commissioner of the Energy Transitions Commission, in conversation with Lord Adair Turner, who will give a presentation. Today, we're going to talk about a path forward for transition finance. We've been working on this project for some time. Credit Suisse has been supporting us, and we've been in deep dialogue about what we do about transition finance. Before I do that, I do have to have a nod to all our sponsors, because this particular conference has been supported by many organisations and not just Credit Suisse. Amundi, AIIB, Goldman Sachs, Refinitiv, HSBC, Luxembourg, BNP Paribas, JP Morgan, and others have been willing to take a punt on this idea that we will focus on transitions going forward. This is actually a financial sector issue going forward now, and we have a lot of support for tackling what I'm going to call the tough sectors of the economy that we haven't put enough energy into in the past. There's a couple of housekeeping issues. There's a Q&A function that you can use in the app. Use it. A few questions will be sent up to us, that is Marisa and I, so we can answer them. There are simultaneous translations, 5 in fact. Lots of interpreters working here, so use them if you find the English isn't quite working for you. Everything will be recorded and available tomorrow right through to December on the app, but you have to use the app. And also remember at the bottom of the screen, our hashtag for tweeting. Hashtag CBIConf20. That's it. We're now going into the session. What you need to know is that in 20 minutes or so, Francine Lacqua, who's an anchor at Bloomberg Television, is going to join us to grill Marisa and I on what this is all about. We're going to get in first and run through the key PowerPoint and share with you what we've already shared with Francine about what we're doing just to prep. She's coming off her TV show, which ends in 20 minutes, and then coming straight onto our call, just in case you're wondering why it's working like this way. Okay, Marisa, let's dive into it. Behind all of this is this concept that there are many pathways to Paris. Transition is one of them. We've posited that under the broader umbrella of how we get to where we have to get to, otherwise we are not going to have a sustainable future for our children, we need to do a lot of things. We've been calling some things green. It's worked. We've got $1 trillion market in green bonds, let alone the green loan market, which is at least another $1 trillion as far as we can see. We've also seen daughters of the green bond market arise, which are different kinds of approaches to the labelling. Sustainability bonds. Thailand has just closed a sovereign sustainability bond. Blue bonds for ocean or marine investments. Resilience investments. We saw EBRD, the European Bank of Reconstruction and Development, issue something last year, $700 million worth, or 700 euros, if I remember correctly, 700 million euros. So these are all flavors of things that are about achieving the Paris Climate Change Agreement. What we're talking about today is this beginning idea, and this idea we want to promote, of transition label as another key factor in a key aspect of the market in achieving the transition to the Paris Climate Agreement. Have I got that, Marisa? Have I got that right, Marisa? Over to you.
I think you do. You do indeed. So I guess maybe to add some color and context to this transition label, this is a response from my point of view into what we perceived as a gap in the market. I call it the triangle of demand, because as we were engaging through our own capital markets activities at Credit Suisse, and I suspect many of our peer banks were seeing the same, investors were telling us many times that they wanted, certainly we see the supply-demand imbalance in that the green bonds that are coming to market are heavily oversubscribed. And our investor community keeps asking us, when can you bring us more, more, more? But in addition to that, we are hearing from investors that not only do they want more, but they would like a greater diversity of issuers. So while the green bond market is heavily dominated by the sovereign sector, the FIG sector, et cetera, our issuers are saying they'd like to see more corporates enter the fray. They also are liking to see more uses of proceeds, so beyond traditionally green uses of proceeds in, say, alternative energy or what have you. They would like to see more of that. And then finally, they'd like to see a broader diversity up and down the credit curve. Because again, we're highly dominated by investment grade issuers, but to get yield in a portfolio of green, you'd like to see those who maybe are a little bit lower rated. So that was the issuer community on the one hand. On the other hand, as a bank, we are having regulators come to us all the time saying, why isn't the capital markets doing a better job at accelerating the finance of those critical sectors that have to transition? So we understand the already green, but it's going to be game over unless we get traditional high carbon emitters to invest in this corporate transition. And we think the capital markets have a big role to play, and hey, you banks, why aren't you financing that? And then the final piece of it is the issuers themselves. While the green bond market, as you said, has been tremendously effective, mobilizing $1 trillion and plus of capital just on the bond side, issuers who are in the high carbon emitting sectors were often bemoaning to us that they felt excluded, even though many of them have a very genuine desire to invest in their transition, and they'd like a dedicated pool of capital to do that. So when you think about this triangle across the investors, the regulators and governments, and the issuers, we felt that there was a real gap in the market. So that led us to this conversation really, Sean, over a year ago, where we said, well, should we be expanding the green bond framework and the market principles to include these high carbon emitters? Or is there maybe a better answer to create a dedicated market for those who are in transition? And if so, how can we go about doing that in a really credible and rigorous way? So of course, we don't invite the prospect of greenwashing, which I think all of us who are practitioners in the community want to ensure that we're protecting against. I think I've lost your sound, Sean. Oh, there you go.
Marisa.
The joys of technology.
I know. Well, I mean, it's also the pain of getting used to a new way of working together, right? Like, I mean, this is ending up getting our carbon emissions way down. But we've got to learn a whole lot of new tools, new products, and so on, and running a global conference online over 3 days with 3,000 people is perfectly an example of that. But we've got to do more of it, because one thing that's sure, that's certain, out of this, we have to try and keep up the momentum of reduced emissions over the next 10 years that we've achieved thanks to a virus. So we'll be doing more of this and learning, and by this time next year, who knows, this is going to be an entirely different medium, all online, but it's going to evolve like television did in the 1950s. In the meantime, let's get back to where our thinking went. We proposed in our paper, which is live now in the Wover app and has been launched in the media this morning, 5 principles to underpin an ambitious transition. We're saying first, if we're going to transition, clearly we've got to have a destination. You can't transition to some nowhere land. And there is a destination which is vital to the sustainability of our societies and our economies. And that's the Paris Agreement. So transition needs to be underpinned by a 1.5 trajectory approach. That's step 1, if you like. Now, what the Intergovernmental Panel on Climate Change says is that needs to be zero net carbon globally, not just in Europe, not just in the US, but globally averaged, which probably means tougher targets in richer countries, and halving emissions by 2030. So that's the background where we get there. It's got to be linked to science. We spent a lot of time over the last 30 years talking about climate goals and then saying, yeah, that's going to be really tough, but I'll tell you what about we do this kind of climate goal? That's doable in the political economy. And that's why we're in the mess we're in now, where emissions have not gone down. They flatlined last year, hallelujah, but they're supposed to go down. And as a result, the reduction path that we have to achieve to try and stabilize climate is now so steep. So science needs to be used here now. No longer can we continue to ignore the scientists because it looks hard, etc. We have to say, this is what we're going to do, and then go back and how to get there, which is the theme of this whole conference. Offsets don't count here for the purposes of transition finance. So we need a credible transition goal and pathway in the industrial sectors we're looking at. But as Marisa said, we do have to look at these sectors and have proper transition pathways. We can't just ignore them. It's important we bring them into the equation. Technological viability trumps economic competitiveness. Now, of course, economic competitiveness will always be an issue in achieving the outcome. Going back to that point earlier about science versus political economy, we start off with what we have to do. That involves looking at what we can do in different sectors with current technology solutions available to us. No guessing about R&D that might come through the system. That's not going to work for us in this. And then we look at how we might shape our economies to achieve that outcome. And that will be something we'll definitely talk about in tomorrow's session on steel and fossil fuels, and on Thursday's sessions on hydrogen and steel. Sorry, tomorrow's on coal and fossil fuels, and other sessions. So tune in for our further discussion about this. And then the final principle is, it's got to be real. You know, we've had a lot of promises. I mean, coal plants saying that will bring in carbon capture and sequestration eventually and so on. This doesn't cut the mustard anymore. In the EU taxonomy, where we've specifically said that transition is a critical thing we need to look at, we've said that commitments to bring in something, for example, carbon capture and sequestration to a gas plant, are absolutely good, but they need to be backed by some kind of contract. They can't be a promise that we'll get to it in the 2030s and so on. So action, not pledges. And it also means at a government level, we're not looking at promises that we're going to do something by 2050 now. That's great context, political rhetoric. We want to look at what the actual pathways are, what the CapEx pathways are to achieve it. So this is these are 5 basic principles. Have I got that right, Marisa?
You do indeed.
Let me keep going now. So now we have the interesting thing, and Marisa, I might ask you to run us through some of this, which are the kinds of activities and entities that we can include here. Start us off.
Well, certainly in the past, and the green bond market has been very focused on uses of proceeds, green uses of proceeds. And as we thought about transitions, those in the high carbon emitting sectors, of course, they may invest in very discrete projects, but what we're really thinking about here in the green transition is a whole entity exercise. And we wanted to make sure that we were inclusive and provided for that, because we know hundreds of billions are going to be needed to invest in this corporate transition. And when we're talking about these commitments biting and being real, we need to be thinking about this as being deeply a part of the operations of any given entity. So we're very clear in this framework that we want to include whole entities, but we certainly don't want to exclude specific project-related activities. But we also want to make sure that when we talk about being inclusive, we also don't want to limit this to one asset class. We think asset-backed financing, thinking about equity finance, and so on, all of that should be part of this overall framework so that we can ensure that when this finance needs to be invested in these companies and get them down this path, that we're using all available resource to get us there. So
it means that an electric utility would be potentially able to issue use of proceeds style bonds at the extension of the existing market. They might be able to look at activities. They might be able to look at previously high carbon things that have not been part of this. And one we're currently in discussions with the World Bank and others is around gas flaring, for example. It doesn't extend the life of an asset. There's huge emissions involved. There's a CapEx requirement to get it down. And it's an easy win. People aren't doing it because it doesn't fit into the economics of their projects, or they haven't invested in the right kind of thing. So let's at least get the low-hanging fruit done now and start bringing it into early fossil fuel plant closure. You'll hear about that in tomorrow's session. We've allowed in the European taxonomy the idea of upgrading gas networks to be green hydrogen or hydrogen ready. And we've seen 2 bonds already issued that finance that kind of activity, from Cadent in the UK and from SNAM in Italy. And we're saying, we're not going to ask you in this case, to have a comprehensive plan to bring hydrogen on to justify that investment. We're simply going to give you a procurement list for Paris. And on that procurement list are stuff in the high carbon industry that we're going to be able to repurpose to low carbon as we work on the back end of getting that green hydrogen in. Thursday morning session, folks. So in the meantime, SNAM simply says, right, we've done retrofitting of pipelines, basically making them plastic instead of metal. They're ready for hydrogen. We can count that. And yes, you can count that. That's got to be worked through, right through the fossil fuel sector. We're essentially identifying stuff that is going to survive that we'll need in 2050. And we need to identify stuff in the existing fossil fuel network where we can get emissions down with adequate ambition, which will improve things while we continue to sweat those assets, which we'll still need to do for the next 15 to 25 years. So that gives you a flavour of what we can do. Where we want to get to, a little bit more complicated, is this whole entity thing. We want to be able to look at BP's transition plan. We need to be able to say, is that robust or not in the context of the CapEx plan, not just a sort of abstract decarbonisation target, but as it real and reportable against, and make an assessment. And investors make an assessment, yes, that is in line with what we have to do. Now, when BP first came out for 2050 net zero carbon plan, we were all a little bit anxious because there's a hell of a lot of there was initially a hell of a lot of CapEx in fossil fuels still part of that strategy. That would mean at first that climate bonds, well, we could bring in the green investments they're making, but we're not going to be able to look at BP as an overall issuer. Now, next week, they're on a roadshow with their new plan for that 2050, what it looks like, and it's looking very interesting. 50 gigawatts of commitment to renewable, but a whole lot of other stuff too. So now we've got much more granular detail to make an assessment about whether the BP plan should be included. One of the things we're looking to see whether we can get to, this market can get to, over the coming 12 months, is to be able to say, you know what, all of BP bonds should now be in. And Marisa, wouldn't that be a crazy turn-up compared to what we were talking about 2 years ago? That's
no
where
doubt about it.
That's where we have to get to, because we need to be able to assess entity level now, as well as granular CapEx investments. But we're not talking about entity level with a series of ESG indicators. That's all useful. What we're talking about is looking at it against an appropriate benchmark for those industries and those sectors that is commensurate with the Paris Agreement, which is pretty tough. So it is a tough hurdle, but it's a necessary hurdle. Hey, I'm looking forward to BP green bonds. I've said it to the public record. Let's see what people say. I might get flamed today by saying that, after we've done the hard work of assessment, of course. Okay, so how does this actually work? Let's just have a look at an example of a flow chart. Our team has put together this wonderfully complicated process. Is the entity currently near zero? Is the first question you ask. If it's yes, then it meets the transition principles. If it's no, well, is there a credible entry-level transition strategy being followed that is in line with the Paris Agreement? Yes, it'll meet the transition principles. No, we have to look elsewhere. Oops, sorry, I'm getting a bit excited here with my clicking. And then we're looking at, is it a near zero entity green label that's appropriate? Should we be looking at a green or a transition label? If there's no pathway to zero and there are stranded assets involved, yet it's not going to work here. That's kind of the idea, right? And this can work for sovereigns, this can work for a coal company, it can work for a waste-to-energy company. All sorts of aspects here. This is a really easy to understand chart, Marisa. I mean, everyone's going to be able to get this, right? Or am I a bit optimistic?
Well, Sean, I think that's the reason it's taken us a year. I mean, we really have tried to apply a logic, but also hopefully provide these types of flow charts so you can work your way through to get to an answer. And, you know, I think the question at hand will certainly be, what is the difference between a green label and a transition label if we're going to go down this route of trying to create a dedicated market for transition? And I think that's where the subtlety and the nuance comes into play. And this chart very well illustrates it. So something that is already a zero pathway or is very, very clear that it'll get to net zero like renewable energy, a well-trodden path clearly with wind and solar and what have you, that certainly lends itself to continuing with the green label. But then the question is, on the transition side, pathway to zero. Is it obvious, clear, and are we on the way? Probably lends itself more to the green arena. If there's something that says we are truly in transition, and particularly those, and this speaks to more toward the far right, the interim, is it going to decarbonize for a period of time until we have a better substitute? We think that that's viable because this is all about a quick reduction in carbon emissions. And in some cases, we know what the answer is. In other cases, there is something better out there, but it may not be the final answer. And then as you so well put it, Sean, there are places where we know there is no future, period, full stop, by now or even 2050. And there, I think we want to hold ourselves to a high standard and say, we really don't want to apply a label in this context to those types of issuances or issuers.
And at this point, Francine's with us. Francine,
Wonderful.
thank you for having dialed in from your Bloomberg set, and really appreciate you being able to join us. I know you've just finished. I hope you've been able to take a breath from finishing your piece. And for the listeners, the idea here is that Francine, now we have a conversation with Francine about this. She's going to grill us a bit. We've given you a proposition. What are the tough questions, Francine? I'm a little bit nervous,
Right.
I have to say.
Sean and Marisa, thank you so much. And I mean, congratulations, first of all, on what you've put out today. But how, I mean, my first question is, how is this different to what we had so far in terms of transition? Sean first, maybe.
So what we've done in the market so far is grow a thematic market, which is simply where, you know, it's a fantastic idea. All it is if I want to buy money from my uncle for a car, I go to my uncle and say, I will guarantee to pay it back. And my uncle says, that's great, but I want you to buy an electric car because I think it's going to be safer. All right, I'll buy an electric car. All right. And you have to come back every year and take me out for a drive at Christmas to prove you've still got the electric car. Okay, that's a green bond. So we established this really cute idea, which has flowered and grown and even led to price difference. So if I borrow money from an uncle to buy a petrol car versus an electric car, I actually end up paying a differential interest rate, even though I'm guaranteeing it myself. Who would have thought this? This is what's going on in the market. Now we need to go beyond the electric cars. We need to tackle the areas of the economy that are really tough, which we haven't given enough attention to, and who have been frozen out of this market, including the fossil fuel industry, but not just the fossil fuel industry, the cement industry, the steel industry, the plastics industry. We need steel. I mean, I ride a bike. It still uses steel. It's not just cars or heavy industry that use it. So how do we get those to zero carbon? And that is where we have to look at transition. And now we need to understand what to do and finance it using this market, create huge financing opportunities for those sectors to incentivize them to shift and make sure they understand what the solutions pathway is as part of it. That's kind of what we're getting. What do you think? Is that a good argument?
I would only add to that to say that if we think about what is going to get us to a net zero world, and I don't want to preempt tomorrow's speech by Lord Turner because he articulates this very well, but it has to be made up of a variety of different inputs. So on the one hand, we've got technological intervention or disruption, so alternatives to what exists today, but that's only a piece of the equation. It is this whole concept of transitioning existing industry is got to be a part of the equation. And the hardest one probably, or equally hard, is going to be reduction in consumption, but that we're not going to tackle that one today. So there is a place for this transition. It is going to require hundreds of billions of capital. And it's our belief that if we can create a framework that is an industry adopted one, and there is a common taxonomy for what transition means, then we have every hope of creating scale, which I think is one of our objectives here, just like the green bond market did. But in the absence of some sort of a framework that is adopted by all of our peers in the industry, the practitioners, and of course the issuers, so we know what transition means when we use that terminology, then we're going to have a market of sort of idiosyncratic issuances rather than something that really can move capital at scale.
Marisa, what do you see as the biggest hurdles, I guess, for adoption of this transition framework?
I think it starts certainly with a common definition. So today, what we have in the absence of a framework like this is self-labeled issuances. So issuers and underwriters can call something transition, but that terminology or that label, if you will, is in the eye of the beholder. And I sympathize, and I've had feedback from investors who say, it is impossible for me to identify and do the deep diligence on every single transaction that comes with a different label. We're not equipped to do that, and nor does it create something that gives us great confidence. What we'd like is something that we can all as a market adopt universally, just like we did with the green bond framework and principles. Then the market knows that there's rigor when something is labeled, and then that allows the capital to move in scale. So I think the biggest hurdle is this common definition and common taxonomy, so to speak. That's certainly the starting point. And then, of course, we need the issuers to enter the market and be willing to be our guinea pig, so to speak, to test out this label. And hopefully we will have the investment community prepared to invest behind us. And they're indicating that they will, so that's a very encouraging sign.
Sean, you agree? I mean, is there another hurdle that we can't, dismiss?
Well, there are a lot of hurdles. I mean, we've had, for example, on the Q&A line now, Babatunde Olatujo asked, how do we build consensus for transitions? That's a hurdle. And what we're saying is, it's actually not about consensus. We don't need everyone to agree what transitions are. We need our scientists to be clear. What we've done in the last 30 years is get caught up in this idea that everyone has to agree on the transition. Guys, this is like going to a doctor. It's a medical diagnosis. You ask your cancer specialist what to do, and then you do it. Or you decide to die quietly, that's fine. But I'm not in that camp for climate change yet. So we've got a diagnosis. We're getting a diagnosis. We're saying, give us a bit more detail about the transition aspects of the diagnosis. We'll be asking the scientists this, as we already have been, and then we're going to go and do it. That's what this is all about. And we will grow a huge and massive market. Why? Because investors are looking for the prescription for the future, the procurement plan for the Paris Agreement. We heard in the previous session, the surveys by PRI, Principles for Responsible Investment, saying that investors all believe the change is coming. It's happening. They just are not sure where it's going to occur and how long it's going to take in Washington, DC. But hey, that's just one capital. So the question is not about if, it's simply about when and where, and how do I prepare my portfolio? What we're doing is we're mapping out the areas where the change will happen and will be positive. So you've now got a risk mitigation plan. If you want to reduce risk in your forward portfolio, guys, here's the shopping list. You can be reasonably sure this is going to be lower risk because it's part of the transition plan. And then you can figure out how you deal with risk in other sectors. And that's why it's popular. And that's why investors, as Marisa said, are calling for this stuff.
The only thing I would add is we want to invite in. This isn't something that Sean and we are cooking up in a vacuum. As part of this exercise, we have asked for input from a variety of stakeholders in a limited fashion. But now today with this announcement, we would really like to invite all market practitioners from all sides, whether it be issuers, investors, thought leaders, scientists, academics, etc., to please provide input and give us some feedback. And then hopefully that allows us to continue to iterate through to get to a point where we've got something that has a broad adoption and a broad agreement that this is the way to go.
I have a couple of great questions actually from people listening in or watching. Marisa, maybe this one's for you. How popular do you think transition bonds are amongst investors who care about returns?
There's no question. Just as we've seen with the green bond market, and the prior panelists said, I think in the past the excuse could have been used that this was going to be they didn't transition, right? The existing issuers and high carbon emitting sectors didn't transition because it was going to be all too costly. I think we've crossed that threshold now, and we believe that where value gets created is by following the path to net zero. And in fact, if you flipped it another way, those who don't transition are likely going to lose extraordinary value as the world moves on. This is a critical imperative, and I think that most of the world agrees that this is the case. And if that is the path, then I think those who do not transition are at their peril. So in terms of value creation, we see it, or the corollary of that, of course, is value destruction for those who really want to ignore all of this.
I mean,
Have
Francine,
Yeah.
we had Exxon drop out of the S&P 100 a couple of weeks ago. You know, that
First
is
time since the 1930s, right, Sean?
that is an amazing milestone. What we're seeing in front of us already is value destruction in companies that are not moving and value creation in companies that are moving. Look at Ørsted, which was a coal-fired power plant energy company in Denmark. They shifted to a radical renewable energy strategy. They have way outperformed the S&P over the last 10 years, while their compatriot utilities who've been keeping in fossil fuels have had their valuation collapse all over the place. So, you know, that's just one example. That's what's been going on. There's a misnomer here. The idea that somehow or other you have to sacrifice returns for this. Actually, this is the reverse. What we're doing is identifying sectors where you have a higher probability of improved returns because it's part of the future and is part of what policy transition risk is going to deliver. So it's a risk mitigation tool to do this. It's not a sacrificing of returns.
Marisa was talking about, you know, dialogue and really inviting people to have a dialogue about what they want, about what they see. Is this the only way to make markets, you know, adopt this and accept this, Marisa?
You mean this label, this transition concept? Well, I guess what I always like to do is, rather than reinvent the wheel, let's take a look at best practice and where it's worked before. And that was instructive to us when we saw the gap in the market. We said, well, where has it worked before? And it has worked very, very well in the green bond market, $1 trillion market, as Sean said earlier. So then we say, okay, so if that worked and that was so effective, that was a decade in the making, by the way. And we just passed the 10-year mark from the very first ever green bond issuance by the World Bank. I think the time frame is going to be much more compressed now, given the urgency here. But if we take what worked there and apply it here, I think that is really where the scale comes in. So it's not the only path for sure, but it does have the makings of the ability to mobilize the big pools of capital. And why is that? Because this is a liquid traded market, which is one of the requirements for most institutional investors. Of course, there are opportunities to invest for great value in the green world where they are illiquid investments and they require patience over a decade or so to realize. There's certainly a place for that too. But that, in the context of the overall market size and where we need to get to from an investment point of view, when we deal in the liquid traded markets, that is where you see much bigger opportunities for the capital to flow.
Sean?
She said it, I mean,
Beautifully.
The key point she's saying is we're not talking about inventing a new market from scratch here. That would be an error. When you get illiquidity premiums for a start, that'd be a real problem. We're talking about extending a market into a new area. So we want a large, liquid, climate-related market. So investors can have a single portfolio. Issuers can have multiple types of bonds they issue out of a single program. So we don't get those differential yield curves that come from fragmenting your issuance program if you're a sovereign. So it's one market. There are just flavors of ice pop. There's a raspberry flavor, a lemon flavor, but it's all ice pop. Does that make sense?
It does. I have another great question, actually, which is how, Sean, maybe you can kick us off. How can we measure the impact of transition? How difficult is it to measure the difference that you'll be making with this?
Well, there's a macro thing, right? What we're trying to do is to drive the right capex and activity business line transitions to different sorts of companies by making it preferential for them to get green money and therefore preferential for them to do those kinds of activities. That's really it. Now, we're not going to say this bond is going to change treasury, and we're trying to make it really easy, because if a corporation builds a green hydrogen pipeline, we're not going to say necessarily, give us a 2-year projection of how green hydrogen is going to flow. But what we do with taxonomy work and definition work is we simply say that pipeline is part of the solution. So the gap between what happens at an entity level and how they justify their activities and the macro picture is there. It's the macro picture that we count. So what we're talking about is what a transition pathway has got to look like in steel and hydrogen, what it means for CapEx and companies. They just get their marching orders for what they do, and we track the change in that sector. That's what we have to do. And look, that's what we should be doing everywhere. We need to look at a granular approach across society of all the things that we have to do, make it clear, make it simple what people have to do, let them get on with it within a financial market that will support them, and keep looking at the overarching tracking of how we're going. This is why the work of the Energy Transitions Commission that Marisa has been on has been so influential and so important, because it's the first major piece of work in industrial and energy sectors to give us the framework to do that.
Marisa, is that how, I mean, is there another way? I guess you need a common language, right, to just measure the impact as well.
That's right. But I mean, fundamentally, we are solving for Paris alignment. So that is CO2 reductions. Now, from the starting point to the end point, can one isolate in specificity each individual issuer? Little harder. If we say, but we're Paris aligned, we're all driving to a comparison. If I did not invest this capital and kept doing the same old thing, the answer is the carbon emissions would stay the same. By investing this money on that transition, then you should be able to measure that reduction in CO2. Now, the one thing I would say is that the world is focused solely on, has been to date, largely focused solely on CO2 emissions. What we're finding, of course, for climate mitigation, which is really what at its essence we're trying to support here is tackling climate change, is the concept of biodiversity. Now that is early days in terms of being able to have broad adoption on science-based targets. The speakers today raised that issue. But just as CO2 became a benchmark to solve for in the broad financial, corporate, and regulatory markets, my view is over time that science-based targets around biodiversity will be something that ultimately we can hopefully come to adoption and agreement on as well. And then they can be part of the numeric equation that we're solving for as time passes. So it's all about pushing this agenda to ultimately, hopefully, saving ourselves from extinction, CO2 first, and then thinking more holistically about what are the other aspects that we need our companies and our investors to be trying to drive toward.
Marisa, a question which I also had is how is this transition framework actually different to the EU taxonomy that includes some transition activities?
Not different. So we're trying to adopt and incorporate the EU taxonomy into this overall framework concept. We don't want to be forging a different path. Today, there is no universal definition for green. And I applaud the EU for trying to create this taxonomy that will be broadly adopted. And we certainly hope that regulators around the world will also follow. But we definitely want to work in harmony with the best-in-class regulation that's out there. That, again, it gets back to this concept of creating a market that investors and issuers have confidence in, and that has broad adoption across all those various stakeholders. We want support from all aspects, regulators, issuers, corporates, et cetera, in order to make this scale the way the green bond market has.
Francine, I should add, because for my sins, I'm a member of the technical expert group that helped create that taxonomy in the European Union. Think of this as providing more detail and more structure to what was started in the EU taxonomy. We were very clear in our final report to the Commission that we weren't finishing the job, we were laying the framework for more work that would need to be done. And now we're starting on the next level of that work. That's what this paper is about.
Sean, one of the other questions is, should we view the EU taxonomy as a standard for green investment, or should we view the EU taxonomy as a standard for transition? I mean, we kind of touched on that.
The EU taxonomy covers 3 areas. There are sustainable or low carbon investments. Let's say a solar farm that'll qualify in 2050, you build it now. There are enabling investments, which are detailed, the manufacturing of wind turbine or a triple glazed window, that sort of stuff. And then there are transition investments where the goalposts will move or we have to drive transition. And so what we're picking up in this particular paper is mainly that third leg. We're now providing more detail. But I do want to say that Marisa's raised a really good point. In the last session of this conference we're running, there is a transition to resilience section. And that's where ecosystems and biodiversity are so critical, because when we talk about resilience, we're not just talking about coastal protection for the or flooding in New York so we don't have another Hurricane Sandy problem. We're also talking about making sure our ecosystems are healthy, and biodiversity is the indicator of that. So there's a bunch of stuff we've got to do more work on. The EU taxonomy's flagged doing more work in the future. We're just getting going on the R&D, if you like, and that'll feed into the EU taxonomy process next year.
And I would also add to that, that we learn as we go. So we aren't the fully formed beast, and none of us can claim to be. And a good example of that is biofuels, as an example. That was going to be a great hope for substitute for petrol in vehicles. And then as time passed, we found that with biofuels were based on a monocrop, namely corn, that was highly destructive to the natural environment and created all sorts of other issues as it related to the health of the planet. And so, the world has largely moved away from biofuels as being the true answer and substitute, although conceptually at the outset, it seemed like a good idea. So I think as we go, we're continuously wanting to be informed by science and good academics that are going to feed into this. And as Sean said, all of us are a work in process. So transition is really the operative word here, both in terms of moving the corporate business models, but also moving our thinking in terms of how these sorts of labels and what underpins them will evolve over time.
I'm getting a number of questions, and I'm going to try and condense them, about people being worried about, greenwashing. How do we avoid greenwashing? So Marisa, what goals should we focus on in the investment framework for transition bonds in order to avoid greenwashing?
Yes, well, this is our starting point, was that in the absence of a market adopted framework, we do lend ourselves when then you otherwise have the phenomenon of self-labeled issuances, a lack of confidence in the market and a prospect of potentially, inviting in those who are less well-intentioned or those who are less rigorous. And so by creating at least what we call the 5 principles for ambitious transition, we're setting out what we think good looks like. And one of the ones that speaks to me very, very strongly is the concept of action has got to be backed up by a plan. It can't just be, particularly talking about entity level transition, a pledge to get there really doesn't stand up to the type of scrutiny that we believe is needed. If you say you're going to get there, then give us a plan for how you're going to do it with really concrete metrics. I think that's what we mean when we say, let's hold ourselves to a very high standard as we get into this subject, which is subjective, by admission. This concept of transition is not one hard number. It is a broader sort of aspects to consider there. So as much as we can pin this down in terms of the pathways that become viable, or at least pathways to something else that are less carbon emitting, and we can get adoption on those pathways and agreement with climate science and the broader community, that's the way we'll hold ourselves continuously accountable.
Sean?
Yeah, that's exactly right. I want to say something that I haven't said before, which is there's a particularly big opportunity which came up in the previous session, which is for sovereigns. Where we've got a strong sovereign plan, and Helen Mountford from the New Climate Economy was talking earlier about how we're going to see it. Sovereigns can start issuing bonds in this area too. They've been issuing green bonds. Germany closed a fantastic deal earlier this week, for example, like unbelievable deal. 33 billion euros of orders for a 6.5 billion placement, and some very interesting news that sharing about pricing. But of course, the next thing, when you're investing in how to transition your economy, like South Africa has to do now, with an incredibly coal-intensive economy, and there is a strong plan formulating that we'll hear about tomorrow, then they could be issuing sovereigns to finance the transition activities in their fossil fuel industry or in their other sectors too. They've got a just transition plan. And that's a slightly different take, but the opportunity is massive for those countries that have had trouble moving so far for one reason or another. So I just want to put that on the table. It's not just corporates. It's not just banks. It's also countries. And we've got a year coming up, possibly a few years, of massive levels of sovereign issuance globally as a response to the crisis to restart our economies. We want to make sure that we build back better, that we do it in the right kind of way. And transition has got to be a significant part of that story.
Marisa, I have another great question. There are a lot of transition finance developments seen in debt instruments. What are some ways to promote transition or green financing widely across all asset classes?
So by its design, we actually are hoping that this framework, because it's not speaking to a particular asset class, will be adopted by any asset class. So we wanted to be very open to say, you could apply this exact same framework to an equity investment, to a structured product, to something that is, an asset-backed security, as we sort of alluded to a little bit earlier. So this is a framework that's really supposed to be pretty comprehensive to say that the amount of money that needs to be invested is so substantial in the transition that we want the framework to apply to whether debt or equity or anything in between.
Sean, I have another great question, which is so this person's asking, how will these transition bond incentive potential issuers to reduce emissions, especially when there's no clear benefit in terms of costs of capital to do so?
Well, first, you're wrong about that last question. The benefits are palpable. Let me just start with the easy part. If you issue bonds in the green bond market, and remember we're proposing this as an extension of that, you will get investor diversification. You have higher rates of investors coming from different sectors. The lowest I've seen about 5 years ago was 17% new investors to the book, but usually it's much more than that. Now, if you're a treasurer, I mean, that's gold dust, right? Because if you get more investors, that's going to make it easier for you to run your issuance program going forward. 1. 2, you are going to get stickiness of investors. Now, stickiness is the word that the Treasury of KfW, the German Development Bank, uses. They were shocked when they did their first huge green bond because they got existing investors phone them up and say, love your green bond, tell me more about it. And that deepened the relationship, which really surprised them and is now a feature of the talks they give on the circuit about their green bond program. Now, if you're a treasurer, don't you want rusted on investors? Well, yeah, you probably do. 3, now we get to the data side of it. We now see strong secondary market performance for green bonds. And remember, this is an extension. That is, there are people hold them, they don't trade them as much, they're worth more, and they are having capital retention characteristics. In downturns, green bonds seem to hold their value compared to vanilla. So we're getting people entering the green bond market now who are purely after the capital retention characteristics, not that the fact that they're green. And that leads to downward pressure on primary. What are we seeing? A bit of downward pressure on primary. So the Germans claim they got a 1 basis point benefit, but we're talking about a teensy minus, so it's actually proportionally a massive benefit to much higher bips we're seeing in the European or liquid currencies, in US dollars and European. So there's pricing benefit appearing. The reason I gave that introduction is it's not sentiment. It's hard-headed views about the premium value of this product in the secondary market. If you're an issuer and you can bring a transition bond to market, you're going to get this. So in fact, there are amazing benefits for issuers. By the way, coup de grace, I've just got to share this with you. 2 academic studies, Marisa, we've seen now that show, one from Europe, one from Hong Kong, a share price bounce. When you issue a green bond, if you're a corporate, your share price goes up and it stays up. And does the board know about this?
Yeah, I was going to actually sort of add another dimension there. While it's maybe less concrete, and I would 100% concur with you, that in all markets, pricing tension gets created when you have a greater demand than supply. And with the amount of money that is flowing into green and transition and ESG strategies, by definition, today we're seeing far more demand than supply of issuers. So you can calculate for a traditional corporate bond by the same issuer side by side with a tenor adjusted bond in the green bond market, you can see a differential. So there's that, you can point to that. But I would say in the bigger context of the direction of travel, in addition to the money that will continue to flow in ESG strategies, we also have this little phenomenon called the regulators. And the regulators are going to asset managers now, and the EU is bringing in the EU action plan that is going to be asking banks and asset managers to demonstrate that they've taken these ESG into consideration in the investment products that they create, the advice that they're giving to clients. So just by that nudge from a regulator saying, we want you to demonstrate this, they're creating more demand to flow to these strategies too. So if you're an issuer and you can issue in this category that fits those ESG criteria, you'll see that incremental level of demand. So this is continuing to build over time in terms of favorability to the issuer. And then the softer bit that you talked a little bit about, the share price, but it's also, I would call the sort of vocal activist shareholders who are demanding of companies that they have credible transition plans. And we've seen this phenomenon of coalitions of activist shareholders going to the high carbon emitting industries and saying, if you want me to hold your stock, you're going to have hard targets on CO2 emissions, as an example. And if you don't have a good answer to that, we're going to have a hard time continuing to stay invested in your company. So that equity story aspect of it over time, I think will become more and more of a serious point for chief executives and boards of directors of companies, and really pushing them to think about this transition.
All right, well, thank you both very much. It really answered my questions and put them simply and nicely and neatly. So thank you. We're out of time, unfortunately, Sean.
Thank you, Francine, for joining us. Thank you, Marisa. Folks, in half an hour, there is another session. We're going to hear about government leadership, including the EU story that Marisa was talking about a minute ago. Please join us. You'll need to log in to another session. Thank you so much for being with us today. Look forward to further conversations. And Francine, I'm sorry I missed your show because we were on air. Next time.
We'll do a show together.
And we invite everybody to join us in this journey. So please give us feedback on our framework, because we really want to incorporate as much as we can so that we make it the best and biggest it can be and mobilize those trillions of capital that we're all talking about. So thanks, everyone.
Thanks, everyone.